Good morning, everyone, and thank you for joining us. It's great to see so much interest in today's topic amongst the very busy London Climate Action Week schedule. As a reminder, this webinar is recorded. Please use the Q&A section throughout. We will hopefully have some time in the end to answer questions. If not, if you feel comfortable, include your name and we will follow up afterwards. I'm Victoria Tetzlaff, manager at Agendi, a specialist sustainability advisory firm. And joining me today is Roger Lewis. Over the next 45 minutes, we'll be looking at how the Net Zero Asset Managers initiative has evolved, what the recent relaunch means in practice, and most importantly, how firms can translate the commitment into a credible investment strategy. Over the last few years, we have seen net zero commitments move from being largely aspirational statements to something that investors, clients, and regulators increasingly expect to be supported by robust governance, measurable actions, and transparent reporting. Fitting with the theme of London Climate Action Week, where we have broadly observed a shift from ambition to action. This webinar also comes at a time where there's complexity across the landscape of sustainability, motivators and pressures. Expectations continue to evolve, regulatory requirements differ across jurisdictions, and firms are balancing climate ambitions with fiduciary duties and changing client mandates. Today's session is really about navigating that complexity. We will discuss the NZAM, what the NZAM relaunch means from earlier this year, how the Net Zero Investment Framework provides a practical implementation approach, and the key decisions asset managers should be considering whether they're making a new commitment or strengthening an existing one. Before we begin, a brief introduction to Agendi. We are specialist climate and sustainability consultancy, supporting organizations across the full sustainability journey, from climate strategy, emission measurements, through the target setting, transition planning, implementation, and reporting. Within financial services, we work with investors, asset managers, asset owners on topics including financed emissions, portfolio alignment, stewardship strategies, transition planning, and sustainability reporting. And increasingly, these topics become more interconnected. Net zero isn't simply about setting a target. It requires robust data, governance, investment processes, stewardship, and disclosure, working together as part of a coherent investment strategy. That's really the perspective we'll bring throughout today's discussion. Not just what the guidance says, but how organizations are operationalizing it in practice. Today's session is structured into 4 parts. We begin by setting the context, looking at how investor expectations have evolved and why credible implementation is coming into focus. We'll then spend the majority of the session stepping through an implementation roadmap via the lens of the Net Zero Asset Managers Initiative and the Net Zero Investment Framework. We'll explain what has changed following the 2026 relaunch, the practical implications for signatories, and walk through a structured implementation roadmap. Finally, we will close with some key takeaways before moving into questions. As I said before, we are recording this session. We encourage you to submit questions throughout using the Q&A function. We'll answer as many as we can at the end, or then follow up directly after the webinar. Now that we've set the scene, let's look at how the Net Zero Asset Managers Initiative has evolved, why it has changed, and what it means for firms considering or maintaining a commitment today. Over the last few years, we've seen a fundamental shift in how net zero is viewed across the investment industry. Initially, many organizations focused on making public commitments. But today, the expectation is increasingly around demonstrating credible implementation, showing how climate considerations are embedded into investment decisions, stewardship activities, and portfolio management. There are really 3 forces driving this shift. So when we look at first, client and market expectations, asset owners are no longer simply looking for commitments, they're looking for credible decarbonization pathways and evidence that climate considerations are influencing investment outcomes. Increasingly, firms are also expected to demonstrate alignment with broader market frameworks such as NZAM, ISSB, and emerging UK sustainability reporting standards. Second is regulatory and accountability pressure. Across jurisdictions, we are seeing greater emphasis on transition plans, interim targets, and transparent reporting. At the same time, scrutiny around greenwashing continues to increase, meaning organizations need to be able to evidence the rationale behind their targets, methodologies, and investment decisions. And finally, there's the investment case itself. Climate change is increasingly recognized as a financial risk and opportunity. Physical in-transition risks are being reflected in asset valuations, sector performance, and capital allocation decisions, while investment opportunities continue to emerge across the transition economy. Taken together, these drivers mean that net zero is no longer simply a sustainability initiative. It has become part of mainstream investment strategy, risk management, and fiduciary decision-making. And it's within this context that initiatives such as NZAM have continued to evolve. And with this, I'm handing it over to Roger.
Thank you. That was a good overview of net zero asset managers. But in order to give a kind of a rounded, balanced perspective, it's important to consider the challenges and some of the barriers with net zero as well. I think this first challenge is a big one. The whole world, the whole economy has been built around fossil fuels for the last 2 centuries. Humans went from burning wood to coal to oil and now gas. You can't switch that off easily. Think about some of the biggest sectors. We've got power. 80% of that is still fossil fuels, despite renewables. Or agriculture. Population of the world's heading towards 9 billion people, all need to be fed with fossil fuel-based fertilizer. Or plastics, the petrochemical industry. Think about plastics. They're inside our bodies. They're all around us as well. So again, you can't switch this off easily. And demand for fossil fuels is still increasing. We're well beyond 100 million barrels per day. And even renewables, yes, renewables are great, but they still have emissions. Think about mining for minerals and then a factory in China powered by coal making solar panels, and then you ship those panels to Europe or to America. And there is a powerful lobby. So yes, we're talking about implementation for net zero. What about the lobby against net zero? Because it won't be cheap to decarbonize the whole world. And when it hits people's wallets, there's already a cost of living crisis. So when net zero hits people's wallets, of course, there's going to be pushback and lobbying against it. So that's definitely a barrier, I think, the fossil fuel world. Another barrier, again, thinking about the last century, is historically, environmental and social impacts have been left off companies' balance sheets and P&L statements. Victoria mentioned asset owners in the intro. Now, if we think about the investment, it's almost like a chain, like a 4-link chain. You've got asset owners at the top. Think about DB, DC, pension funds, insurers, foundations. It's their money that we're investing. They're advised by investment consultants who do strategic asset allocations, and then they assign that capital to asset managers, investors, picking investments, picking stocks or real estate. And at the bottom, you've got the actual investee, the company receiving the debt or the equity as an investment. So it's a 4-link chain. And throughout that whole chain, historically, environmental and societal factors were not considered. If a company wants to pump chemicals into a river or pump carbon into the atmosphere, so what? You didn't have to pay for that externality. And now you're saying you've got to disclose these environmental impacts and you've got to pay for them, like a carbon tax. Of course, there's going to be pushback. I think what the chain has done well, certainly in the last 5 years or longer, is start to at least report some of these externalities. Think about the state of California. That's got climate disclosure rules, or CDP, 25 years old soon. So I think, yes, we're good at reporting these, but not necessarily action, which is the third challenge, the third barrier here. Again, the prevailing approach to sustainability has been reporting, producing nice disclosures in your annual report. But that doesn't really address the sustainability crisis. Whenever I talk about sustainability, I say the crisis, there's 3 things. You've got too much carbon in the atmosphere causing climate change. You've got really degraded natural capital and ecosystems, and you've got big inequalities in society. And there's a quote from the University of Cambridge that I like. They say, there's no business on a dead planet. So if you think about, we're doing a lot of ESG reporting. It's great. Absolutely, there's a role for sustainability storytelling, but is that really helping to avoid a dead planet? And then the final barrier or factor for implementation is a lot of corporate change initiatives fail. I think there's some academic research that said about 70% of companies' change initiatives fail. And sustainability, the transformation, that's a massive corporate change initiative. Think about it. You've got to innovate new products. You've got to change your business model. Remember the externalities I just mentioned. You've got lots of stakeholders to manage, like your investors or your regulator or your customers or your staff. There's a lot of regulatory complexity as well. I mean, the biggest example here of a failed change initiative is BP. At the end of last decade, they were calling themselves Beyond Petroleum. And then look what happened in the last few weeks. They've got rid of their chair and they're backtracking. So the future is not renewables, it's not solar. It's actually still going to be digging for and refining fossil fuels, just like it was. That's an example of a failed change initiative, which again is a barrier to net zero, I think, alongside some of these other ones. So yeah, there are definitely some challenges around net zero. And I think a key way to address these challenges as investors is through stewardship. So if we look at the next slide, we're going to talk a bit about investor stewardship with net zero and some of these challenges, some of these barriers in mind. I think it's always good to start with first principles. So we're doing engagements. What are our guiding principles? Here, it's useful to set expectation statements. So if we're giving you debt or equity capital, what do we expect from a sustainability view? I think the very minimum is at least having a policy, an ESG policy, and reporting your carbon emissions. I think for the mid-2020s, that's kind of the minimum an investee company should be doing. I think some other guiding principles are we need to be clear on what our role is as investors. I know Victoria introduced myself earlier, just to give you background. I've been an ESG investor for many years. I'm kind of giving you the investor stewardship perspective here. Our role as investors is to empower our investees to achieve positive change themselves. It's not to manage the companies. I'm not a manager for a food company or a power utility. I'm an investor sharing my perspective. And what we want to do, we want to have a structured and a targeted dialogue with the company. So we're sending them letters, we're having calls with the company, we're tracking our progress and we're reporting outcomes. If you think about net zero stewardship, some of the subjects include scenarios. If the Paris Agreement goals are met in an orderly way or a disorderly way, or what if they're not met? In those scenarios, what happens to the value of your investment? Or what kind of risks, climate or financial risks, are our investee companies exposed to? A good example of this is a house building company that we invested in Florida a few years ago. Now, for sectors like construction or agriculture, that's based on outdoor work. If you're exposed to extreme heat, the human body can't cool itself down effectively, which basically means they cannot work. So instead of working an 8-hour day, they're actually working a 4-hour day, which think about basic economics, your output goes down, therefore your revenue goes down. And I remember engaging with the company about this, and they hadn't actually considered that as a risk. All their revenue forecast models were based on an 8-hour day rather than a shortened day as well. So that's an example of a climate financial risk, which we would seek to at least understand and encourage the company to think about as an investor through our stewardship. And there's some similar subjects as well for stewardship. Could be asset impairments. A company buys a machine, but then the machine has a shorter useful life or higher maintenance cost because it needs more coolant or upgrades because of extreme weather. CapEx and OpEx for decarbonizing. I think Victoria said it in the intro. A lot of companies have made commitments, but how are they actually going to pay for those commitments? I remember engaging with Schneider Electric a few years ago, and they've got massive commitments. And when I asked their chief sustainability person, where does the money come from? She didn't know. She just makes the request to her treasury team, say, I need 100 million euros for some decarbonizing initiatives. And then she gets that. But then what if the company's got to issue more debt? or there's an opportunity cost. There's other projects, maybe expanding to a new market or launching a new product that they cannot do because they've got a net zero commitment. So it's kind of that. It's good for ESG, but all about the financial return. And that's why we're doing stewardship. It's the fiduciary duty. Remember the chain. We're the asset managers. We owe a fiduciary duty to the asset owner, which basically means a duty of loyalty and a duty of care. So we do need to think about return as well as ESG outcomes. And then final thoughts on stewardship. It can be contentious. So absolutely, we're talking about net zero here. Stewardship plays a really important role in that, but it does have drawbacks or disadvantages to be aware of as well. A common one, again, I've seen this in the past, is the free rider problem. So imagine I own 3% of a company and I dedicate lots of resource to engaging with that company, sending them letters, having calls with them, encouraging them to decarbonize. And then they do that, they improve their energy efficiency or they reduce their operational carbon emissions. And then the market rewards them. They get a lower cost of capital, revenue goes up, dividends go up. The other 97% of shareholders are all going to benefit from that, even though they didn't do the engagement. It was myself as the engaged investor. So I think that's one to be aware of. I think there's a lot of collaborative engagements. Some of our audience might be aware of Climate Action 100 or Nature Action 100. It's good coming together. Look at SpaceX, the IPO last week. Even the biggest investors probably own a tiny percentage of that company. But if you're coming together with not just me as one investor, if there's 7 or 8 investment firms collaborating, engaging the same company on the same subject around their emissions targets or their climate disclosure or their capex, then you've got 20 or 30% of the market cap, and you're much more likely to have a good outcome for net zero. But then you've got to think about conflicts of interest and confidentiality. We're competitors, but then we're working together to engage the company. And what about collusion? Are we working together to move the share price? That's illegal. That's kind of market manipulation. So I think definitely stewardship is good, but there's definitely some contentious points to be aware of as well. Victoria, back to you.
Mm-hmm. Thank you, Roger. Now we're moving into the NZAM commitments and an implementation roadmap. So earlier this year, the Net Zero Asset Manager initiative was relaunched with a revisited set of commitments, reflecting how both the market and investor expectations have evolved. The initiative remains a global coalition of asset managers committed to supporting the transition to net zero. They represent over 250 global asset managers, approximately 3.7 trillion USD in assets under management. But the emphasis has shifted from a very prescriptive commitment model towards a more flexible, principle-based approach. And rather than requiring firms to follow a single implementation pathway, the updated commitments recognize that investment managers operate across different jurisdictions, asset classes, and client mandates, and therefore need greater flexibility in how they deliver net zero outcomes. There are 3 themes I'd like to highlight. So first, there's a strong emphasis on supporting clients. The commitment recognizes that asset managers act on behalf of their clients, so implementation should help them understand climate-related financial risk and opportunities, like in those examples that Roger mentions, and support them in achieving their own investment objectives. Second, the focus has broadened from emissions reductions alone to financing the transition. So alongside setting interim targets, there's now greater emphasis on increasing investment in climate solutions in supporting investee companies to address material climate risks through stewardship and engagement. And finally, transparency remains central. So signatories are expected to publish how they intend to implement these commitments and report on progress annually, reinforcing accountability while allowing flexibility in delivery. The important point is that the ambition hasn't reduced. It has evolved, it has matured, it has changed, and the initiatives now places greater emphasis on demonstrating a credible implementation approach that aligns with fiduciary duty, client mandates, and real-world investment decision-making. We have talked about the commitment itself, but the obvious next question is, how do organizations actually implement this? And this is where the Net Zero Investment Framework, or NZIF, comes in. Developed by the Institutional Investor Group on Climate Change, the NZIF is a voluntary implementation framework that translates high-level net zero ambitions into practical investment processes. In other words, with NZAM, you set the direction into commitments, while the NZIF provides a roadmap. The framework is designed to help investors align portfolios with a net zero pathway while continuing to meet their fiduciary responsibilities. Importantly, it isn't intended to prescribe a single investment strategy. Instead, it provides a structured approach that firms can apply according to their investment philosophy, client mandates, and asset classes. Another significant development is the release of the NZIF 2.0, which broadens the framework beyond listed equities. As you can see, it now includes implementation guidance across a range of asset classes, including, as you can see on the right-hand side, corporate fixed income, sovereign debt, real estate, infrastructure, private equity, and private debt. That expansion reflects the reality that achieving portfolio-wide net zero alignment requires a consistent approach across the entire investment portfolio, not just one asset class. The framework itself is voluntary, but it has become one of the most widely recognized references for investors developing credible net zero strategies because it provides practical guidance on governance, target setting, portfolio construction, stewardship, and reporting. Ultimately, the NZIF provides a structured methodology for integrating climate considerations into investment decision-making in a way that is transparent, consistent, and defensible. Having introduced the NZIF and NZAM commitments before, let's now look at what implementation actually involves in practice. And although every organization will approach this slightly differently, we found that successful implementation generally follows 4 connected stages. So the first one is the commitment alignment and readiness for commitment. So understanding your current investment strategy, governance, client mandates, into organizational capabilities needed to support a net zero commitment. The second stage is portfolio assessment and transition planning, which is typically the most analytical part of the process. So it includes understanding like your financed emissions, assessing different climate scenario, what that means for your portfolio, assessing your portfolio alignment, setting targets, and then developing credible transition pathways. The third stage focuses on stewardship and engagement. For many asset managers, stewardship is one of the most powerful levers available to influence real-world outcomes. This means establishing clear stewardship priorities, engaging with investee companies, and maintaining transparent communication with clients throughout the journey. And finally, implementation doesn't end once targets are set. It requires ongoing disclosure, monitoring, and progress tracking so organizations can demonstrate their progress, respond to changing market conditions, and refine their approach over time. One point I'd emphasize is that it isn't a linear process, even if it looks like one here. As of course your portfolios evolve, regulations develop, client expectations change, firms continually revisit each of those stages, and net zero implementation is more like an iterative cycle of assessment, action, and continuous improvement rather than one-off exercise. Over the next few slides, we'll walk through each step of this roadmap in more detail, and I hand it over to Roger for the first part.
Thank you. This is almost a big one. Like, why are we doing this? Where do we begin? And I think this is where you start to see almost like the corporate realities versus the actual wording of the commitment. In my last role, we were ordered by a big asset owner to make the net zero commitments. So again, why? A lot of asset managers are driven by their asset owners. And then this is where you almost start to see a distinction or kind of division. You've got a group level commitment because net zero is done at the group, the firm level. And then that firm manages individual funds. And it's the fund manager's decision for their fund to either join or not join the commitment. They're the ones with the fiduciary responsibility for the fund. And that's why you often see not 100% of a firm's assets are in scope for net zero, because if you're trying to shrink an investment universe, you say to a fund manager, you can't invest in fossil fuel sectors, even though, like I said, it's still going to be a booming sector this century, and there's opportunities for a return there. Versus another fund whose clients, the investors, say that we want this fund to be net zero as well. So I think definitely understanding that readiness assessment, it's a question for the fund managers and the percentage of AUM that's in scope. But in theory, it's got to be 100% eventually. So often you'll see maybe 20% for the first year and then 40%. And each year you revisit. And ideally, or in theory, the percentage of AUM in scope increases. But I think that's kind of in theory, but in reality, it doesn't always work that way. You can almost get maybe one or two funds in scope, 10% of AUM, and you could stay there for a long time because the fund managers aren't ready to join or to make the commitment. I think when you're in scope, there's definitely policy that helps us. I'm thinking specifically about the SEC had climate disclosure rules that were proposed, audited sustainability, non-financial data. There was lobbying against that, but that would have made our cause a lot easier because we need sustainability data as a net zero asset manager. And I think for investors, with that point about data in mind, you should always start with the investment management agreement. That's our contract with the asset owner. And within that, what role does ESG data and climate data play? If I think about how I do pre-investment research for sustainability, we think about impact alignment. So we're looking to invest in a company or a building or an infrastructure project. How does that align with net zero? Particularly if that's your objective or the characteristics of the fund. Sometimes it's easy, like renewable power, of course, 20% renewables, investing in a solar park does align. But what about the risks and controversies? Are there any red flags? And think about climate analytics. I mentioned scenarios already, but temperature scoring can be really powerful as well. I was looking at a Japanese equity fund at the start of this year, and that held a lot of shipping and construction names. And then based on these companies that it held, it's actually contributing to a 3.1 degree world. That was the temperature score, which if you think the Paris Agreement is 1.5 or 2 degrees, if you're contributing to a 3 degree world, that's quite bad. And again, if that fund was thinking about making the net zero commitment, that's almost a fundamental shift. And my point earlier about change initiatives failing, it's almost like everything this fund holds or has held for years cannot hold anymore because it's a 3 degree fund. It needs to be more like a 2 degree fund as well. So that's the role of ESG data. The challenge there is how do you link that to financial outputs? You get a score 3 degrees or 80% for sustainability. What does that mean in terms of your investment rate of return? It essentially means if you put this money in a bank, what's the percentage return you're going to get by investing in this project instead? And I think as part of a readiness assessment, I think we talked about stewardship a lot. Victoria just said it's one of the most powerful levers. I think just one final observation on stewardship. A lot of companies have decarbonized a lot already, and they've almost done everything they can, like energy efficiency, or they're on renewable energy tariffs, or they don't do as much business travel, which means their emissions are going to flatline now. So how can they reduce them even further, even with good stewardship? And absolutely, we need strong governance here. Think about boards and executive management teams. Do they understand net zero and decarbonizing? Are they supportive? Because there is a lot of cultural change that's going to be needed. So there's a lot to consider. Making the commitments easy, just sign a piece of paper saying, yeah, we're a net zero asset manager. I think there's about 250 firms that have re-signed the commitments, a few $1 trillion worth of assets under management. But practical tips like that, the fund manager considerations, the board's support, the data you've got, and how you're going to do stewardship, they're all essential as part of a readiness assessment as well. Victoria.
Thank you, Roger. Moving on to the next part of the roadmap. So the first step in understanding a portfolio's transition pathway is establishing a robust baseline for financed emissions. For asset managers, financed emissions will be the largest part of the greenhouse gas emissions inventory. In the industry standard for calculating those is the Partnership for Carbon Accounting Financials, or PCAF. At a high level, the methodology is relatively straightforward. It begins by identifying the holdings within the portfolio in collecting emissions data for those investee companies. So where reported emissions are available, that's straightforward and easy. Where they aren't available, then estimated data can be used, and provided the methodology, of course, is transparent and appropriate for the asset class. PCAF then applies an attribution factor, so allocating a proportion of an investee's emissions to the investor based on its financial exposure. So, for example, the ownership share or the enterprise value, those attributed emissions are then aggregated to produce a portfolio-level financed emissions baseline. And one of the strengths of the framework is that it supports a broad range of asset classes, including listed equity, corporate bonds, sovereign debt, real estate, project finance, private markets, allowing firms to apply a consistent methodology across increasingly diverse portfolios. Calculating financed emissions helps organizations understand where emissions are concentrated and establish a baseline for target setting. But on their own, they don't indicate whether portfolios aligned with a credible transition pathway or how climate risks are evolving over time. This is why financed emissions are typically combined with scenario analysis, portfolio alignment assessment, and stewardship activities to provide a more complete picture of transition performance. Once you've established your portfolio baseline, the next step is to understand how that portfolio performs under different climate futures. Roger already mentioned the Japanese example. So really like looking at climate scenario analysis to understand how your portfolios develop in the future. And then, of course, rather than attempting to predict one single future, scenario analysis helps organizations assess how different transition pathways and physical climate outcomes could affect portfolio performance, sector exposures, and long-term investment risks. And this is why frameworks such as ISSB and TCFD place such a strong emphasis on forward-looking analysis. So the objective isn't simply to model emissions, it's to understand the resiliency of investment portfolios under a range of plausible climate scenarios. A robust scenario analysis typically starts by selecting a range of credible climate pathways. So, for example, an orderly transition, a delayed transition, or a higher warming scenario. And from there, organizations identify the financial and non-financial metrics they want to assess, such as portfolio value, sector exposures, emissions intensity, or climate-related revenues. The next step is to evaluate how those scenarios could affect different sectors, asset classes, and individual holdings, helping identify where the portfolio is most exposed to transition risk, physical risk, and emerging investment opportunities. Increasingly, organizations are also broadening this analysis beyond climate alone to consider, for example, nature-related risk dependencies and broader sustainability factors, recognizing that these issues are interconnected. The real value of scenario analysis is that it informs decision-making, it helps shape transition pathways, prioritize stewardship activities, and refine portfolio construction, and provides an evidence base for target setting and capital allocation. Ultimately, scenario analysis isn't about predicting the future, it's about making better investment decisions under an uncertain future. Once you've assessed your portfolio and are ready to establish targets, the next question is, which framework is most appropriate for your organization? We have outlined on the slide the key target setting frameworks that are applicable. They're all recognized under the NZAM initiative. So we already talked earlier about NZIF, and it's the most principle-based one out of those. Provides a very practical roadmap for integrating net zero across your investment process, from portfolio assessment and target setting through to stewardship, transition planning, and reporting. And its flexibility makes it particularly well suited to organizations with diverse portfolios and multiple asset classes. The Science-Based Targets Initiative for financial institutions is more prescriptive. It provides recognized methodologies and strict validation criteria. Next, we have the Net Zero Asset Owner Alliance Target Setting Protocol. which is specifically designed for asset owners. It provides structured guidance for setting and implementing portfolio targets across large institutional portfolios, in particular relevant where long-term ownership in strategic asset allocations are the primary focus. When selecting the appropriate framework, your approach will depend on factors such as organizational maturity, investment philosophy, client expectations, available resources, and whether external target validation is a priority. In the end, these frameworks are complementary. For example, many organizations use the NZIF as their overarching implementation framework while applying SBTI methodologies to validate individual portfolio targets. Once targets have been established, the focus needs to shift how targets will actually be delivered. And one of the biggest misconceptions here is that there's a single pathway to achieving portfolio decarbonization, whereas in reality, most credible net zero strategies combine a number of complementary approaches. So you can approach at portfolio level, of course. So firms might set overall decarbonization trajectories and adjust portfolio makeups over time to align with those ambitions. You can do it on a sector level. For many assets, company engagement is one of the most important levers. So we talked a lot about stewardship already, and we will come up to more details in a moment. And of course, capital allocation plays a critical role as well. So net zero isn't about reducing exposure, or isn't only about reducing exposure to high emitting activities. It's also about increasing investment in companies, technologies, and infrastructure that enable the transition to a low carbon economy. Finally, there may be circumstances where exclusions or phase-out policies are appropriate. So, for example, when investments are fundamentally inconsistent with an organization's investment belief or the client mandates. And although there are, of course, competing priorities at play regarding this, the overarching message is that there will be a combination of levers, and all these levers have a role to play in achieving net zero. I hand it over to Roger now to talk more about stewardship and engagement.
Thank you. Similar concept. Again, I'm going to share some of the practical experiences, having worked with net zero asset managers, for many years. I think this kind of climate ladder just shows what Victoria has just explained at the fund level. How does a fund go from making the commitment, when we talk about the impact readiness, through to actually achieving net zero? I just wanted to add quickly, I was on some of the working groups that were involved in relaunching net zero asset managers. I mean, it was an achievement. Some of you may be aware of net zero banks. Similar idea, some headline names left that. That's dead. That didn't relaunch. That's finished. There's no such thing as net zero banks anymore. Whereas net zero asset managers did relaunch, and it's much more pragmatic as well. I think Victoria's hinted at that. It's not as strict as before. If climate science evolves, or if your asset owner requirements change, or there's new policy, or you learn something from your stewardship, you can reflect that in your commitment. I think we've talked a lot about micro level stewardships, kind of engaging directly with your investees. There's also macro level stewardship, policy advocacy. And this is important because, again, thinking as an investor, a lot of companies make a carbon commitment, but then their lobbying disagrees with that. They're still lobbying for more fossil fuels or less disclosure. So it's almost like one hand doesn't know what the other's doing. And I'm thinking about the UK specifically. Two political parties have already said if they win the next election before 2029, they're going to cancel the Climate Change Act of 2008, which for the UK puts net zero in law. And you can imagine that. So if the country level net zero commitment is repealed, what does that mean for a sector level net zero commitment like NZAM as well? But that's an example of policy advocacy. So for us as net zero managers, that would be bad. So we should be engaging, writing letters to the politicians, engaging with consultations, joining working groups, having dialogues with them, saying, no, you shouldn't cancel the Climate Change Act. But that's an example of kind of the policy advocacy, macro stewardship, which is important as well. I think there's also, again, taking the fund perspective, if we've got some dirty assets, maybe a gas power peaking plant or some refining assets in West Africa, if we just sell that, that looks good for a net zero commitment, but it doesn't actually achieve much from a decarbonisation point of view because the emissions still happen. And the planet doesn't care who owns this asset, on a piece of paper. The emissions are still getting pumped into the atmosphere as well. So, and that's part of stewardship as well. It's almost ESG at exit. And what is the buyer? You're just selling it and think, okay, it's someone else's problem, or you're actually engaging with the buyer and then using that to inform your decision to sell as well. I think there's the NZIF guidance, which this kind of operationalizes it into a bit more detail. You can either tilt towards or away from certain sectors, and then when you're doing your bottom-up stock picking, refer to net zero. I think also, again, Victoria, you mentioned private markets. Absolutely. I mean, it's universal issue in ESG, including net zero. It's built around public markets, but a lot of the concepts can apply to private markets as well. Remember the investment chain? I mentioned asset owners, investment consultants doing asset allocations. Historically, asset allocations were 60% equities, 40% bonds. Those days are long gone. Now it's more like a third equities, a third bonds, a third private market. So it's a massive asset class in its own right. And therefore, yes, you can get emissions data from your assets. You can do analytics on them, and then you can engage. How do you decarbonize this? I think that top part of the ladder there, carbon removal, that would be a focus, I think, for the 2030s, because this is not gross zero. This commitment is net zero. There will still be emissions. Remember my very first point, this will still be a fossil fuel century. So say we've got a fund, it's responsible for 100,000 tons of carbon. We engage, we report, we get the data, we reduce that to 50,000 tons of carbon. Great. We still need to remove 50,000 tons from the atmosphere. And that's how you get to net zero. But I think that'll be a future London Climate Week when we're talking about carbon removal, not this one. Victoria.
Perfect. Thank you, Roger. I'm quickly wrapping us up now because we are almost running out of time. But last step, disclosure in progress tracking. Obviously, you have to report your progress. We already talked about that in the beginning. Annual reporting, you can, for NZAM signatories, you can report through the PI reporting framework. It's listed here. I quickly jump to the key takeaways. We have 5 main key takeaways here. So first, the relaunch of NZAM provides greater flexibility. We talked about that in more detail. Second, and this is also the theme of London Climate Action Week, the net zero conversation has, and quite widely so, shifted towards implementation. It's not only all about commitments, it's also about implementation and how you reach those commitments. Third, the next zero investment framework, provides a practical roadmap for implementation. Already looked into that. Fourth, portfolio assessment will be your analytical foundation. You, of course, have to understand first your finance emissions, where they sit, what climate, how climate scenarios look differently for your portfolio, how your portfolios are aligned or not aligned. And then finally, stewardship and transparent disclosure are what brings your strategy to life. So they demonstrate how commitments are being translated into measurable investment action and deliver the required confidence to your clients, regulators, and other stakeholders. Unfortunately, we are running out of time here, but we are happy to answer any questions. Feel free to reach out to us. Happy to have a chat or answer anything via email. And we want to thank you all for your time today and your engagement. And please do reach out if you have any more queries. Thank you again, and all the best for the final few days of London Climate Action Week.